Greg, I was going to look to you for a lot of stock market advice, but you're mostly talking economics too, because that's the backdrop that you're using, I guess, to make decisions about investments. But we had the GDP number yesterday in this country, which was above expectations, but in general, you say global GDP growth was below where we thought we'd be.
Yeah, and we have a top-down look at how we invest both fixed income and equity, and we are expecting a global slowdown. And I think the seeds have been planted. I think first quarter is going to surprise on the downside domestically, and we see that with the government shutdown. We see that with Brexit, and obviously the trade issues, not only with China but with Europe.
All right. So based on that backdrop, we had valuations in December get a lot more reasonable. Now they're 20% above where
we're back to where we were in the third quarter. But look at the bond market. The bond market with 10 years up to 275, we actually think, and credit spreads are wider where they were. They haven't tightened all the way to their tight levels in the fourth quarter. So we think there's opportunity in both investment grade and in high yield.
Okay. Tim, as our economist, who do we usually have on from Wells Fargo? We had the guy with the suspenders, don't we? Is that the guy?
Yeah.
Yeah.
You got the short straw this morning, Joe.
Yeah, you got the short straw. So what do you think, as an economist, we had a better number yesterday with GDP than where a lot of people were after that retail sales number, and a pretty solid year, depending on which metric you look at, either 2.9 or fourth quarter over fourth quarter, 3.1, one of the best years we've had in the past decade or so. Yep. What do you really think for 2019? It's a tough call here. The first quarter, give me a first quarter estimate, and then do we decelerate or accelerate from the first quarter?
Yeah, so you're right. Full year growth comes in, depending on the metric you use. Let's call it round numbers 3%, about as fast a pace of economic growth as we've seen, certainly in the late stages of this expansion. That probably marks your high water mark at this point, Joe. We don't have the quarterly rate of GDP growth rising above 3% at any point throughout the course of 2019. Now, that's not to say you don't get a big inventory swing or a one-off contribution that temporarily gets you there. But on a sustained basis, I think you've got to get used to the idea of potential GDP growth being closer to the Fed's estimates of more like 1.9%.
So I just remember in the past there were some, actually they weren't completely false narratives that I used to hear from guys like Austin Goolsbee would come on, and I'd say, look, why isn't the U.S. growing faster? And is it over-regulation or Obamacare? And he'd say, well, look at the rest of the world. We're a global economy, and we're doing better than everyone else. So it's not anything we're doing here. It's that we're in a global economy. But now I'm hearing the same type of people say, well, Trump's stuff, the tax cuts didn't work, and this economic miracle that we're always hearing about isn't happening because we didn't get 4 or 5%. We didn't even quite hit 3. But again, those are the same people that used to talk about the global economy. The global economy is slowing. At least some degree, we're being slowed by the global economy, are we not?
Yeah, I think there's a couple of things to unpack in that. Maybe I'll take with the easy part first, which is the global economy. And I agree with your other guest. I think that there are a lot of indications that global growth is slowing. Whether you look at global export volumes, which typically average year-over-year growth in the order of, say, 5%, are now less than 1% on a year-over-year basis. Or if you look at a canary in the coal mine like South Korea. South Korea is in terms of exports as a share of its economy, is pretty big. It had its biggest year-over-year drop in export volume since 2014. So there's signs that global growth is slowing. As to your epic battles with Austin Goolsbee, I caught many of those when they were happening.
Now it's a Twitter fight. Yeah. Well, actually,
right,
it's not. Actually, we're going to dinner. We're just we're going to work it out together. I think that's what everybody needs.
Glad to hear
do.
that.
Yeah.
I think that a big part of what's at stake in that, though, is just the factors that create potential GDP growth are not what they used to be. The best example of that is labor force growth. We used to be adding at a really fast rate.
Two things we know about. Greg, would you be buying or selling here? You didn't sound too optimistic.
So, on stocks, it's back to levels where we're overvalued on large cap.
You think so?
But small cap, I think there's opportunities because we're seeing bank lending.
Yeah.
So whenever bank lending, private credit expansion picks up, there's opportunity in the small cap.
You mentioned you like some investment grade credit, but you don't like Apple credit for what I saw in your notes. Why is that?
So Apple's going to go through restructuring as they move off the whole iPhone thing, and I think we're going to see a AA. I mean, this is a solid AA credit that doesn't need to be a AA credit. So it's going to, we think it's going to have some credit issues, but it's not. It's not a problem from this. It's a downgrade to single A.
All right, guys. Thanks. I mean, with Austin, he said, you got to buy me. I'll pay. I will treat you, Austin, because like many Americans, I've never felt more positive about my financial future right now, and I can easily afford to pay for wherever Austin wants to go.
You're not allowed to pay
but you know
your
what
guests to be nicer to you, Joe.
No. But what I did say is, wherever we go, I'm ordering meat, Sorkin. I'm sorry. I'm still ordering meat. I'm not gonna, I'm not getting some pasta kale thing. All right? Is that okay with you? Can I do
How about
it? CAOC,
do you not
big
do you not
burger.
eat meat anymore?
Oh, I eat meat. Of course I eat meat.
Well, shame on you.